Welcome to Stock Market Today, your pre-market briefing delivering actionable insights on stocks, bonds, crypto, and the macro events that will move markets this session. Let's cut straight to what matters for your trading day. January 2026 delivered one of the most dramatic transatlantic crises in recent memory, and the implications are still playing out in defense stocks, currency markets, and risk assessments. On January 17th, President Trump dropped a bombshell tariff ultimatum targeting 8 European nations unless a deal was reached on Greenland's sovereignty. $302 billion in U.S.-Europe trade was suddenly on the chopping block. Markets immediately repriced geopolitical risk. The tariff structure was designed for maximum pressure. 10% starting February 1st, escalating to 25% by June 1st. 8 nations in the crosshairs: Denmark, Norway, Sweden, France, Germany, Netherlands, Finland, and the United Kingdom. That's 10.5% of total U.S. imports at risk. According to CNBC reporting, this represented the first major use of tariffs as leverage for territorial claims involving NATO allies, not traditional trade grievances. The S&P 500 dropped 2% in the worst single-day performance since October 2025. European markets went into panic mode. Currency volatility spiked. Investors were suddenly forced to price in the unthinkable: a transatlantic trade war, driven not by economics, but by Arctic territorial ambitions. Behind the scenes, 72 hours of intense diplomatic activity kicked into overdrive. European leaders convened emergency summits in Brussels. The EU floated activating its anti-coercion instrument, what CNBC called the trade bazooka, which would enable countermeasures including suspended trade agreements and export controls. Danish Foreign Minister Lars Løkke Rasmussen drew hard red lines around sovereignty. The risk of a dangerous downward spiral in U.S.-Europe relations became very real. Then, on January 21st, Trump announced a framework deal with NATO regarding Greenland, and tariff threats were withdrawn. Markets exhaled. The S&P 500 rallied to 6,875.62, recovering nearly half the previous day's losses. European equities surged over 2% as trade war fears evaporated. But here's what matters for your trading positions: what's actually in this framework deal and which sectors benefit. First, rare earth mineral access. Greenland is the world's 8th largest holder of rare earth reserves, critical for defense systems, electric vehicles, and advanced electronics. The framework grants the United States and NATO allies access to these resources. This directly addresses a strategic vulnerability since China currently dominates global rare earth production. Supply chain diversification plays just got more interesting. Second, the Golden Dome defense system. This is an integrated missile defense network designed to protect against long-range missile strikes. It represents a significant expansion of NATO's Arctic defensive capabilities. Defense contractors immediately priced in the spending implications. Third, coordinated Arctic security arrangements involving 7 NATO Arctic allies. This is a new paradigm for collective defense in the region, and it comes with a hefty price tag. The Trump administration designated Vice President J.D. Vance, Secretary of State Marco Rubio, and Special Envoy Steve Witkoff to lead ongoing negotiations. That's top-tier personnel commitment, signaling this isn't a one-off diplomatic stunt. Now let's talk market impact. Defense stocks exploded. Northrop Grumman surged 8.3%. Lockheed Martin jumped 7.9%. According to reporting from FinTool, investors recognize the implications for military modernization and Arctic security spending. If you're positioned in aerospace and defense, this framework is a multi-year tailwind. The currency implications are more nuanced. The U.S. dollar experienced weakness due to the abrupt policy reversal. The whipsaw effect created opportunities for forex traders, but highlighted the brittleness of dollar strength when policy credibility gets questioned. Safe haven assets saw increased interest amid ongoing geopolitical uncertainty. European equities recovered strongly, But don't mistake relief for resolution. European leaders are now accelerating strategic autonomy initiatives. That means increased European defense spending, reduced dependence on U.S. security guarantees, and potentially a fundamental reshaping of NATO structures. For investors, this translates to opportunities in European defense stocks and infrastructure plays tied to strategic independence. Here's the precedent that matters. This crisis established a new model of economic coercion. Trade policy was weaponized for geopolitical objectives against traditional allies, not adversaries. According to analysis from the Center for Strategic and International Studies, this approach echoes 2025 China trade tensions, but represents an escalation in applying pressure to allied nations. Risk models that underestimated trade disruption potential among allies need immediate recalibration. The Arctic militarization angle is critical for long-term positioning. Climate change has opened new shipping routes and resource extraction opportunities. Great power competition in the Arctic is intensifying. Russia will respond to these NATO Arctic arrangements. An Arctic arms race is no longer hypothetical. Defense budgets across NATO nations are headed higher, creating sustained demand for military contractors. The rare earth geopolitics deserves special attention. China controls roughly 70% of global rare earth processing. Any alternative supply chain that reduces that dependence has massive strategic value. Greenland's resources could reshape critical mineral markets. Companies with processing capabilities or Arctic mining exposure should be on your radar. Bond markets showed resilience, but remain sensitive to transatlantic stability. The initial shock drove flight-to-quality flows, but the quick resolution prevented sustained disruption. Watch sovereign spreads between U.S. and European debt for signs of renewed tension as implementation details emerge. Crypto markets largely shrugged off the geopolitical drama, continuing to trade on macro liquidity conditions rather than diplomatic tensions. Bitcoin and Ethereum showed no sustained correlation to the Greenland crisis, reinforcing their disconnection from traditional geopolitical risk assets. As of today, February 7th, the framework remains in early implementation. Negotiations continue on technical and legal details. European allies maintain concerns about the precedent while engaging in proposed security arrangements. Danish sovereignty issues remain unresolved despite Trump's characterization. For active traders, several themes require monitoring. Defense sector momentum continues as Arctic spending expectations build. Watch for contract announcements tied to the Golden Dome system. European strategic autonomy initiatives create opportunities in European aerospace and defense names. Currency volatility around policy announcements remains elevated, creating forex opportunities. The geopolitical risk premium just got repriced. Alliance relationships proved more fragile than consensus expected. The speed of the 72-hour cycle from threat to deal to market recovery demonstrates how quickly policy can shift, requiring nimble positioning and robust hedging strategies. Sector rotation implications favor defense, critical minerals, and Arctic infrastructure plays. Traditional transatlantic trade beneficiaries face lingering uncertainty despite the immediate resolution. European exporters remain vulnerable to future tariff threats if this coercive model becomes normalized. The January crisis revealed that trade policy can be deployed against allies as quickly as adversaries when geopolitical objectives align. That's a fundamental shift in how we assess political risk in developed market portfolios. Complacency around allied trade relationships is no longer justified. Looking ahead, implementation details will drive the next wave of market moves. Watch for announcements on Golden Dome contracts, rare earth supply agreements, and European defense budget increases. Any setbacks in negotiations could revive tariff threats and market volatility. The framework deal is a watershed moment in post-Cold War relations. It demonstrates how unilateral action can disrupt traditional alliances while creating investment opportunities in security and strategic resources. The 72 hours from January 17th to January 21st reshaped Arctic geopolitics, and created multi-year investment themes in defense modernization. For today's session, defense stocks remain in focus as investors digest ongoing Arctic policy developments. Monitor any headlines from ongoing negotiations. European markets continue processing strategic autonomy implications. Currency markets remain sensitive to policy signals around alliance cohesion. The Greenland tariff gambit proved that geopolitical coercion can shift from threat to framework deal in 72 hours. But the market implications will play out over years. Position accordingly in defense, critical minerals, and geopolitical hedges. The Arctic just became a major theater for great power competition, and your portfolio needs exposure to that reality. That's your market intel for today. Now get out there and trade smart. For more real-time insights, check out capitalcopilot.io.